Let's start right here. Not what Chairman Powell said, but what your colleague over at the Boston Fed said in the last 24 hours, that this resilience of this economy suggests maybe we might have to do more. You take a different view. Why?
So look, we have to get inflation down to 2%. We all agree on that. I mean, we're all committed to that. The question is how to get there. We are at a restrictive stance, in my view, and we're putting pressure on the economy to slow inflation. The question is whether we need to increase the pressure or just keep pushing. And I'm in the camp right now, just keep the pressure going, let this work through. Again, the data may dictate that we change course, or I change course. But for right now, what I'm seeing and what I'm hearing, particularly soft data, what I'm hearing, I've been around my district all summer talking to people, is that the plea I hear is you've done a lot very quickly, right? You've taken a lot of pressure quickly. Now let us work through that. Let the banking system work through it. Let the corporations work through that. So that, I agree with that. I think we just keep the pressure on and see how things turn out.
Jay Powell didn't really say anything new, but he did sort of cast it in a hawkish light. And he talked about how the economy is perhaps growing faster than anticipated, and that could increase inflationary pressures. So what would it take to get you to change your view and think we need to raise rates more?
If we saw that the decreases in inflation were stalling, right, that we weren't making that progress that we need to make.
But how would that manifest itself? Because the people who calculate CPI, the analysts, suggest we're going to see it go back up just essentially for mechanical reasons.
On the headline side, for sure. But we're going to see shelter inflation come down, right? That it's coming down now. You see this with real-time rents. So if service inflation in particular, or core service inflation, whatever you want to call it, super core, if that continues to stall, then I'd say we have to do more. But again, I really want to emphasize, we are doing something right now. It's not as though keeping rates where they are is doing nothing. We're actually continuing to put pressure on the economy.
You said, and Jay Powell just said, that it was important to get inflation back down to 2%. That was unequivocal.
Correct.
Does it matter when? I mean, we're right now can see in the dots that it's not until after 2025. If it takes till 2030, does it matter?
Oh, yeah, 2030 is a long way off.
2026, 2027, when's this sort of
sense? We're going to get under 4 this year, under 3 next year, and then get to 2 in 2025. So, yeah, it's going to take some time. But what really matters, what I hear all the time is not just a headline, not just super core, but think about the essentials of life, the things that people really need: shelter, food, transportation, energy. As long as they're moving in the right direction, Americans are better off. And we need to be committed to that.
You clearly think we're sufficiently restrictive. Other people think we don't. So let's go through their points. Unemployment's still 3.5%. Growth this quarter could come in at about 3%.
Yep.
What is the evidence that we're sufficiently restrictive? What can you actually point to beyond the soft data? Let's talk about the real hard data.
So inflation is starting to soften. We are hearing story after story, I'm hearing of...
And you think that's connected to where interest rates are right now?
Yeah, and labor markets are definitely easing up. We're hearing this over and over again. It's easier to get employees. And the retail numbers I'm a little suspicious of, because what we're hearing, for example, from a major supplier to the back-to-school market is sales are not what they expected. So we are starting to see these early signs, but they're early, right? And so I don't think we need to react either way right now. Just let this ride a little bit. Let's just keep putting the pressure on.
Well, if you keep the pressure on, but even don't raise rates, how long do you need to keep the pressure on? When would you see moving away from the peak?
Clearly not until next year at the earliest. And when next year, again, the data will have to dictate that.
Well, there is a question about if inflation keeps coming down, real rates continue to rise and put additional pressure on the economy. Would you see the Fed recalibrate its peak rate to keep the pressure steady as opposed to letting it grow? I realize this is a fine point for the markets, and if you if you say this the wrong way, they're all going to start pricing in rate cuts.
Look, it's possible, right? But at this point, we really need to see inflation moving down, and we're seeing early signs of that again. And I'm getting story after story from all our contacts that it is starting to happen. But I want to keep rates where they are right now, and then we'll decide later what we do.
What do you think is happening with labor market wages at this point? Because that was the big concern, especially with Jay Powell's non-housing services. These guys were talking about the United Auto Workers negotiations going on. Have we broken the back of rising wages rising at a too fast a pace?
Too early to tell right now, but it does seem like what I'm hearing from all our contacts is that it is starting to ease, right? I mean, we're not where we were, where mid-year increases are there. Nobody's considering that. So we are starting to see some easing, particularly in the service area, hotels, restaurants, and so forth. We are starting to see it getting a little easier to get the table at the restaurant. And one of the things that I think about, one of the potential risks is that when student loan payments come back in, I don't think it's a big economic issue. I mean, when you run the numbers, it's not, but it's a psychological issue. Here, I've not gotten that $300, $400, $500 bill. Now I get it. And so I've been talking to a lot of people of that generation who are saying, yeah, I may have to back off some of my spending.
Well, but this goes to this question of, okay, well, the savings are going to get borne down, and then we're going to start to see the real economy expose itself, right? A lot of people have questioned that. But I am wondering what kind of neutral rate, what kind of, sort of longer term expectation for the Fed do you expect in the new normal? What does it look like?
Yeah, so we don't know for sure, right? Let's start there. We don't know exactly what that new normal looks like. But one of the things I think about is what's fundamentally shifted in the economy between before the pandemic and now. Remember before the pandemic, hard to remember for all of us, right? Given what we've been through. But we had low interest rates, low unemployment, and low inflation. What's fundamentally shifted? There have been a lot of things. We're going to talk about this in this meeting. There's supply chain issues that are shifting and being re-engineered. But fundamentally, I think it's plausible that we can get back to that. No, I'm not predicting that right now, but it is plausible. So I think we have to realize that we lived in that world. We've proven that that can happen. And so could it happen again? Yes.
Sounds like a base case when I listen to you. Is that your base case?
I don't know. I mean, at this point, I'm not quite sure. But clearly, we think we'll get back to trend growth in a couple of years. We'll get inflation under control in a couple of years. And inflation and unemployment will tick up, but really in the 4-ish range, back to the neutral rate.
You've offered example after example in the last 8 minutes. It's highly anecdotal. Is the beige book now more important to us than US retail sales?
When I step back and I think about myself, and I can only speak for myself, right? When we were going through the early part of the pandemic, and we were saying that inflation was transitory, it was just used vehicles and so forth, what I was hearing from my contacts was now really it's more persistent. And I didn't factor that in. The mistake I made, if I made a mistake, was I didn't factor that really soft data, that anecdotal data. But it's more than anecdotal data. It's what people are really feeling real time in the economy. Now, we've done a lot of things, like done real-time pulse surveys and so forth to get ahead of that now. I don't want to make that same mistake twice. And so what I'm hearing right now from those same contacts is things seem to be slowing more than the data's showing. That could be wrong. That's why we have to, as Chair Powell said, risk management is an important issue here. But if they're right, if that soft data is right, then I think it really then just solidifies my view that we stay putting pressure on, not necessarily increasing right now, to see how that all resolves itself.
Nerd question for our friends on the trading desks out there, especially the bond guys. The balance sheet has been coming down, but very slowly because of the caps and the way that works. You haven't hit maximum reduction yet on a month-by-month basis. And at the same time, we have seen financial conditions remain easier than you would expect. So the question is, do you do more with the balance sheet because it has an effect on how tight the policy is?
At this point, I don't see us changing course on how we're reducing the balance sheet. Again, circumstances could dictate something else. But for right now, I think we just stay the course, keep that on, as I've said many times before, on autopilot. Just let it run. And if we need to adjust policy, we adjust that with the Fed funds rate.
Well, there has been a question on the other side of how close you are to stopping balance sheet reduction when you reach the level of demand.
Yeah, we don't know. I don't think we're there yet, but we do clearly have to monitor that. If you go back to the last time we did this, we knew we were at that point where we needed to stop when we saw the market indicators, the volatility in the market. We've not seen that yet, but we could.
We have seen real yields climb significantly.
Yeah.
Today, 5-year real yields, inflation for adjusted yields, rose to the highest levels going back to 2008. Are you watching that closely as an indication of the transmission mechanism of the balance sheet runoff?
Sure. Yeah, I mean, that's one of many. It's also just a simple trading and things like the Fed funds market and so forth. Not at this point. I mean, but it is clearly something we need to keep watching.
Can I finish on this? Slightly provocative. Have you destroyed the mortgage market in America for a generation?
I don't think so. I mean,
why not?
Well, it is clearly tough when you talk to bankers.
Beyond tough. People are locked into mortgages at two handles for the rest of their lives.
First-time home buyer, really, really hard because there's no inventory. Right? Even if they could afford the mortgage, they can't find a home because people are locked into that low mortgage rate, in their existing home. That's why I think we don't keep going with rates, right? Is that we can stay steady, and at some point, as we reduce rates, we can bring those mortgage rates back down. There's no question that's an issue.
But we're not going back to 2% mortgages over 30 years, are we?
Yeah.
So that inventory is offline, maybe for a generation.
Less.
You're not there yet?
Yeah, because what we're hearing from some of the home builders is they keep selling houses.
Oh, they're having a great time.
Yeah.
Their stock's having a great time.
Right,
You've done that a huge favour.
Yeah.
I'm talking about whether this housing market can really recover in the next several years, given that this feels quite generational. This feels like a really tough time.
But there's a lot of inventory coming online. I can tell you in Philadelphia and across many cities I know, but Philadelphia, for example, a lot of multifamily is coming online in the next few years. So we are increasing inventory.